everyone, for the last sections of the conference. We're going to start with shareholder payouts and short-termism with Jesse Fried, and we have Theo Vermaelen as discussants. Very interesting topic that has been mentioned many times before already today. Jesse, I give you the floor.
Thank you. Great to be here. Thanks, Tom and Mark, whoever he is, for organizing. So the title of this talk is Shareholder Payout and Short-Termism. But another possible title for this talk is How a Guy Named Bill Zonick Confusion about Capital Flows in the United States and in Europe. Okay, so we're going to start with capital flow confusion in the United States. This is a blurry picture of our Congress. So it all sort of starts with a debate over short-termism in the US. And there are people who have said that short-termism is a problem. I'm not going to go into the arguments or the personalities. And there are other people that say, no, it's not a problem. Most prominently, Mark Rowe, whose book is the last thing that's cited on this list here, and perhaps his book will put an end to the debate, but probably not. So since 2015, people, as part of this debate, have focused on the magnitude of shareholder payouts, dividends, and buybacks as evidence of short-termism that's been induced by markets. And the claim is that the activists are causing companies to distribute too much cash. What does it mean to distribute too much cash? Companies don't have enough cash for investment and for paying workers good wages. So the person who is most responsible for advancing this argument is this guy named Bill Zonick, who's smiling in this picture because his piece in the Harvard Business Review, entitled Profits Without Prosperity, won the 2014 HBR McKinsey Award. And this is basically the money quote from the piece. He writes, corporate profitability is not translating into widespread economic prosperity. The allocation of corporate profits to stock buybacks deserve blame. During that period, he looked at 2003 to 2012, but the data is pretty stable for any decade. Companies used 54% of their net income, a total of $2.4 trillion to buy back their own stock, almost all through purchase in the open market. Dividends absorbed an additional 37% of their net income. That left very little for investments in productive capabilities or higher incomes for employees. So that's sort of the money quote. He writes this thing in the Harvard Business Review. It takes off, it goes viral. Everybody starts citing him in his work. Think tanks, Larry Fink, who Mark Rowe mentioned, Marty Lipton, Mark Rowe mentioned, politicians, including Biden, Mark Rowe mentioned, Clinton when she was running for the presidency, Schumer, and a bunch of other Democratic senators, and even some economists who should know better got sucked into this craziness. I was going to say I'm not going to name any names, but I just did. So Charlie Wang from Harvard Business School and I worked on looking at shareholder payouts. I was very lucky to be able to recruit him because I could not have done all this database work myself. And we looked at Zonick's numbers, and they're basically right. We were looking at this figure at a different decade, but it's basically the same. So we were looking here at 2007 and 2016. There was $7 trillion in shareholder payouts, 4.2 trillion in buybacks, 2.8 trillion in dividends, 96% of total net income. Repurchases were probably 2/3 of total shareholder payouts. Repurchases are in green, shareholder payouts are in blue. So everybody thinks buybacks are killing America, they're destroying our country, no investment, blah, blah, blah. So we have Chuck Schumer and Tammy Baldwin introducing a bill to rein in buybacks, basically giving the SEC authority to block buybacks by public companies. Then Baldwin and Elizabeth Warren, our former colleague at Harvard, who comes up with pretty crazy policy proposals, although in her defense, I would say she was an excellent teacher. She wants to ban all open market repurchases. So Charlie Wang and I did a bunch of papers. Some were published in finance journals, published some op-eds about our work. And the question we wanted to address were, do buybacks in fact starve companies of capital necessary for investment? And is there evidence of pervasive and harmful short-termism in the US market? So the big problem with Zonic's paper is that he's looking at buybacks and dividends, and he's not looking at equity issuances. Equity issuances involve capital flowing back to the company from shareholders. And as we're going to see, the volume of equity issuances in public markets in the US is huge, and in Europe is also quite big as well. If you look at companies that are announcing buybacks, and big ones like the big tech companies, they're saying we're gonna buy back $10 billion worth of shares. It's like, wow. But like 2 years later, their share counts have gone up. Outstanding shares have gone up. What's happened? They've been issuing a lot of shares. So they're buying back and issuing, and basically what Zonic is doing is just looking at like one half of the ledger. So Charlie and I looked at equity issuances, and they're very hard to measure because they're not directly reported by companies unless they are equity issuances for cash by the company. So if you look at direct equity issuances by companies, they make up about 30% of total issuances. Some of them are private placements, rights offerings, dividend reinvestments, dividend reinvestment plans, seasoned equity offerings. That's only 30% of total issuances. Most issuances to shareholders are indirect, and I'm gonna show you a diagram shortly to explain what I mean by that. But basically, the company issues equity to employees, for example, or to buy another company, and then those shares get sold into the market and they're absorbed by shareholders who pay cash for them. From the perspective of like where is cash sitting? Is it sitting in the company or is it sitting in shareholders' pockets? All equity issuances are functionally the same. They have the same results. And so if you just focus on direct equity issuances, you miss most of the picture. And of course, Zonic didn't even look at those, at least in his early work. Now, when we pointed out that he should look at equity issuances, he just looked at the direct ones, so he still missed most of what was going on. So this is a simple cash raising issuance by a company. Company has some, ABC has some shareholders. It sells shares in the market. People are buying it, could be the same people that already own, could be new people coming in as shareholders of the company. Cash goes to the company. It's the reverse of a stock buyback. Very simple to understand. This is probably the most important form of equity issuance in the United States, which is giving employees stock. So in the actual transaction, you have ABC again. It pays employees with stock. Stock goes to the employee. They have to hold it for a little bit. Then they sell it into the market and they get cash. Who do they sell it to? They sell it to the pool of ABC shareholders. Okay, so that pool has to give up some cash. That is equivalent to the company going into the market, selling shares, getting cash, and then giving cash to the employee. Everybody is in the exact same position. The employee gets cash. The shareholders have more equity but less cash, and the cash position of the company is neutral. Okay, these two transactions are exactly the same. This is an indirect equity issuance, but it has the same effect as a direct equity issuance, which is why you have to include it among equity issuances. So if you want to look at like money flowing from companies to shareholders, instead of just looking at buybacks and dividends, you want to look at dividends plus equity repurchases, buybacks, minus equity issuances, which is dividends minus net equity issuances. That is the proper measure of cash moving from the company to shareholders. So this figure also spans 2007 to 2016. The gray in the back is market cap, total market cap. The orange is equity issuances. You can see just by eye, and the blue is repurchases, the green is dividends. You can see that equity issuances are greater than dividends, and getting close to repurchases, but somewhat less. So during this period, equity issuances were 3.35 trillion, which is about 80% of the 4.2 trillion in buybacks. So that means that 80% of the buybacks that everybody is getting so excited about are reversed through equity issuances. This figure here shows shareholder payouts, which is dividends and buybacks, which is what Lazonic is worried about, and Elizabeth Warren, our former colleague, who I praise as a great teacher, even though she got the policy wrong, Mark. Just so you know that I wasn't totally belittling her in front of this audience and on Zoom. So anyways, the green series is total shareholder payouts. The orange is net shareholder payouts. And you can see that net shareholder payouts are about half of shareholder payouts. So equity issuances are substantial, and they completely change the picture of how money is flowing from firms to shareholders. You can see in 2009, it was negative. Public companies absorbed more equity capital than they distributed, and that's because of the financial crisis and financial institutions being required to raise a lot of equity. Okay, so we also looked at like the propensity to invest. So we looked at CapEx and R&D over revenue, which is the solid series, and R&D over revenue, which is the dashed series. You can see that CapEx and R&D over revenue was very high during the internet bubble in the late 90s, and it fell and it started coming back up again. You don't have like a secular decline in that measure of propensity to invest. And then R&D over revenue has been increasing dramatically during this period, and it's continued to increase after that. So there's no evidence that investment is being impaired or R&D is being impaired. You can say, well, maybe there'd be even more R&D, more investment if there's more cash, but cash balances have been rising strongly during this period. The solid series as cash and short-term investments went from about 3.5 trillion to 5 trillion during this period, and it's continued to go up. So basically, all of the scare claims advanced by Lazonic about investment collapsing, not enough money for paying people, not enough cash, it's all wrong. So now we come to the EU. So here we have Lazonic again, and we have a repeat of the confusion that happened in the United States when the European Commission seeks guidance on new rules to make European public firms more sustainable. And I put sustainable in quotes because I actually don't know what sustainability really means. Maybe in the next session, somebody can explain it to me or over coffee. But anyways, so the European Commission adopted as a draft a study by Ernst & Young on sustainable corporate governance that was written by like followers and disciples of Lazonic. the guy is extremely effective in getting his ideas out there in a way that like I can only wish that would be like 10% as effective, and defines short-termism and purports to find it in EU firms, including excessive buybacks and foreign investment, and then suggests various cures, including changing directors' duties. And those, since you're all from Europe and are familiar with it, you probably know about all that already. So, so the main finding is that companies focus on the short-term benefits of shareholders rather than on the long-term interests of the company. And they go through a bunch of things. I just want to talk about the payout part because that's what I was assigned to talk about. So the evidence of short-term through payouts is that dividends and repurchases are increasing and high, but just like Lazonic did in his HBR piece, they ignore equity issuances, which far exceed repurchases. So if we look at equity issuances by European companies during the period that Ernst & Young looks at, we'll see that things change dramatically. So this figure shows shareholder payouts, gross shareholder payouts, that is dividends and repurchases, during the period covered by the Ernst & Young report, 1992 to 2017. Shareholder payouts, which are the green series, make up about 65% of net income during 2010 to 2019. And I just picked that period because that's sort of the last, that's the last part of this period. This actually goes to 2019. I'm sorry, I said 2017. But if you subtract out equity issuances, it falls to 38%, which is very similar, interestingly, to the figure in the US. So the same type of confusion that was created in the United States through his 2014 HB article gets exported here through people who read his article or talked to him. And it shows up in this report. The report also doesn't measure investment properly, which I'm not going to talk about, but since it's on the slide, I'll mention it. Doesn't properly measure investment capacity. There was just all sorts of mistakes in the report. Eventually, the regulatory scrutiny board of the commission rejected the draft proposal. You know, as polite Europeans, they didn't say it was garbage. They said something else. But you know, I can read between the lines and sort of see what they're saying. So, anyways, so that got trashed, which is good. And so that sort of seems to be, at least from what I know, the end of the effort to like hammer on shareholder payouts in Europe. But in the United States, we now have a buyback tax of 1%, which Biden said he would raise to 4%. And if you want to know what's driving it, it's like the, I wouldn't say the ghost of William Lazonic because he's still alive, but it's once these ideas get hold in people's minds, you know, you can. Charlie and I were allowed to publish something in the Harvard Business Review, like refuting what Lazonic wrote, although we had to do it in a nice way, which is very much against my nature. And you know, we published other stuff, but like once ideas get entrenched in people's minds and they sort of fit into like a narrative that these people have about short-termism and if you go to a staffer on Capitol Hill and you say like, look, you're concerned about inequality, right? Yes. You're concerned about climate change. Yes. You're concerned about like racism. Yes. Well, guess what? If we cut back on buybacks, we can solve all of these problems. And the way we cut back on these problems, and this is what Lazonic says, is we repeal a rule from 1983 which like allowed buybacks, which is, it's not exactly historically accurate, but if you're a staffer in Capitol Hill working for like a Democratic senator or congressman, and somebody comes to you with like a cure for all of the world's problems, and all you have to do is just deal with buybacks. It's like such a no-brainer. Anyways, so these things have persisted, and we'll continue to deal with them, which will give Charlie and me more work to do, and maybe I'll get another invitation back to Belgium to talk about it again. Thank you.
Right, so good afternoon. Thank you very much for inviting me here. It's a great pleasure to read your great paper, and typically discussing the stories are presented, but I completely agree with you. So my comments will be like complementary comments, because the critique on buybacks is also related to other things other than underinvestment. So I'm a big buyback fan. I wrote my dissertation on share buybacks in 1980 at the University of Chicago, and at that time buybacks were a very infrequent event here. And I came to Belgium in 1982 as a professor, and then I was teaching about share buybacks, and the students protested. Why do we have to know about something that does not exist in Belgium? It's illegal in Europe, right? And it's true. If you look at the number of buyback announcements in the red, are the number of buyback announcement authorization announcements in the US, and then the blue lines are the number of buyback announcements made by other countries. And you can see, this is the one time in my life my predictions are right, that whatever happens in America afterwards comes to the rest of the world here. So when something gets important, people start hating it, right? The biggest hater of buybacks is Chuck Schumer, head of the Democrats in the Senate, and he has on YouTube, you can look at his video. See, I hate stock buybacks. I always thought that YouTube would cancel hate speech, but this is an exception here. I guess if you hate buybacks, it's okay, and if you're a Democrat, right? Let's do this. Instead of investing in workers and in training and research and equipment, they don't do a thing to make the company better, and they artificially raise the stock price by just reducing the number of shares. They're despicable. I like to abolish them. I hope this time the rest of the world is not going to follow America if this happens right. The two major criticisms: buybacks lead to underinvestment, and there is stock price manipulation scheme benefiting insiders. I think Jess's paper really replies to the first complaint here, and it shows that the criticism ignores equity financing, ignores that money received by shareholders get invested elsewhere, and investment intensity has increased in spite of higher payouts, and cash balances have been increasing, so firms have not been starved by payouts here. Now, I have a few major comments here. Basically, you can also maybe add debt financing. A lot of projects are financed with debt, not just by cash, and companies prefer debt financing because interest is tax deductible, the agency cost of free cash flows are lower, and there's less adverse selection than equity. When you issue equity, your stock price tends to go down. The reason is because people think your shares are overvalued, even if you're not overvalued, so you get punished in advance for your sins. So when you get punished in advance for your sins, what should you do? You should sin, right? You should issue only shares when you are overvalued, right? So I tell my students. They do that. The comment also is that some investments are good, but the purpose of a company is not to invest. The purpose is to invest in positive NPV projects. For me, sustainability is quite different from your definition of sustainability. For me, sustainability is making sure that the shareholders of the company earn a competitive rate of return that compensates them for the risk, which means investing in positive NPV projects. So even if you had found that investment had gone down, then I would say, well, investment goes down. Why? Because companies do not invest in negative NPV projects, and buybacks reduce bad investments here. So I want to focus more on the second part of the critique on buyback. It's a stock price manipulation scheme benefiting insiders. This deals with, it creates agency problems in the company here. Now, how to manage the benefit from buybacks? There are a bunch of papers in the literature. There's one that's earnings per share management to increase compensation. That's true, right? If you want to increase earnings per share, you can do it the hard way to increase earnings or reduce the number of shares outstanding, the easy way. I fully agree with this criticism, but the solution: do not make bonuses contingent on EPS. This has nothing to do with buybacks. It's to do with poor governance systems, right? There's a paper by Cal saying that insiders, they increase the value of their stock options by lowering dividends. And of course, it's true. If you have a stock option, the value of an option goes down if the dividend goes up. So, but if you're worried about that, what you can do, you can lower the strike price of options to take away that incentive. And then the strongest criticism comes from Jackson, which is a SEC commissioner, saying that we observe that insiders are selling shares after a buyback announcement. It must be that they are manipulating stock prices here. Now, this is a false assumption that I will explain later on. This comes from a paper I have with Urs Peyer on about more than 3,000 buybacks in the US. and it shows you, I don't know, for those of you that many of you are not in finance, you never heard of an event study. This is what we do for a living. We calculate cumulative excess returns from, this is 60 days, 3 months before the announcement, until 60 days afterwards, around a sample of buyback announcements. There are different types of buybacks. There's Dutch auction, self-tender, privately negotiated, etc. But the critique has always been on the open market buybacks. The open market buybacks are the bottom line here, the bottom blue line, and it shows you here that in the and these are abnormal returns adjusted for risk, adjusted for market movements. As you can see, the typical company that announced a buyback in the open market experiences a negative abnormal return of 7%. So these are companies that are beaten up in the market. And if we're looking at in our paper, why they're beaten up? They're beaten up because they miss earnings per share forecasts, analysts downgrade them, and the management is frustrated, and they announce a buyback program, and the stock price goes up by about 3%, not a lot, but this is kind of this market seems to believe you a little bit, not very much. And then the critique basically is that this jump here is not justified. This is manipulation. So what will happen in the long run is that this thing actually will tend to go down below the initial level, because remember the buyback takes place after the authorization announcement, basically. By the way, why do shareholders like buybacks? Because buybacks basically reduce agency cost of free cash flow. It shows that companies will not waste money in a negative NPV project. It's a signal of confidence in the future. And there's also some tax benefits if you borrow money to buy back stock, basically. So the main critique is that this is kind of a short-term thing, and the overreact manipulation hypothesis would predict a decline of stock prices in the long run. Now, is this really true? This shows what happens in the long run, and I'm looking at two separate samples here. The first sample is the purple sample, contains the quintile with the companies that experience the largest stock price, abnormal stock price declines in the 6 months before the buyback announcement. So those are really beaten up companies. We announce a buyback, nothing much happens in the short run. In the long run, they outperform risk-adjusted benchmark by 50%, showing that those managers on average were right. The people that brought down the stock here were wrong. So when you talk about short-termism, maybe these are evidence of short-termism. That investors were looking at short-term earnings and they missed earnings forecast and they dumped the stock. And the manager said, this is short-termism. I know the long-term is great and I'm going to take advantage of these ignorant people to benefit my long-term stockholders. Now, people have some criticized this is insider trading. It's not insider trading. This is not based on inside information. This is based on disagreement with publicly available information. And there is nothing unethical about this. Because suppose that you did not buy back stock. Suppose you didn't buy back stock, the stocks would remain undervalued here, and so on, and then the investor would still sell them, and someone else will buy them. Who will buy them? A non-investor in the company. So you're transferring wealth from the long-term investors to other investors that are not owning your stock. And that is not, according to me, consistent with fiduciary responsibility. By the way, the green line shows you the abnormal returns, basically from companies that increased a lot in shareholder value in the 6 months before. The stock price went up abnormally. But again, you see there is no reversal here. There's no decline afterwards, which is the prediction of the manipulation hypothesis. This is a paper I've done recently with Alberto Monconi and Spire on global buybacks. This is based on 10,000 buybacks in the US and 10,000 in the rest of the world. We repeat this study and looking at long-term excess returns in 4 areas: Asia Pacific, ex-Japan, which is really Asia Pacific, ex-Japan is really Australia. Then we have Europe here, we have Japan, we have America, ex-US, which is mostly Canada, and then we have the US. Now, this picture is very similar to the other picture before, in some way that in the 6 months, 6 weeks, something before, you see stock prices decline abnormally. So there are companies that are poorly performing. The management announces a buyback, and in the long run, they all outperform the market. So this is actually, by the way, if you want to make money in the stock market, this is the most profitable seminar that you've ever been to. All what you need to go to the onlineinvestor.com. It announces all the buyback programs in the US. And just buy shares after the announcement, and happiness will prevail afterwards. not guaranteed.
You should have slides here.
What?
No investment advice in this seminar. Lawyers, you know.
I came here to sell something. Why do insiders sell after buyback announcement? This is the puzzle, right? Insiders sell after buyback authorization announcement. Well, there's a paper actually, it's a paper that was presented at the American Financial Association meeting in January by 3 economists from Erasmus, and there's really a very nice study. They show basically that if you look at a lot of buyback announcements are announced essentially just after earnings announcements. When companies announce earnings, then they announce the buyback announcement. Okay. Now it also means that insiders are restricted in trading. An insider cannot trade before an earnings announcement. So it turns out to be that earnings announcements and insider selling go together. This is spurious correlation here. So there is no evidence of timing. Buybacks create liquidity, and that's why insiders like to trade during buybacks. And also there's a great famous paper by Lakonishek and Lee on insider selling. When insiders sell, there is no evidence of market timing. Insiders sell for a variety of reasons. They need money to buy a car, to buy a house, to deal with a divorce, whatever. But there is no market timing. The only market timing is insider buying. So I'm not surprised that insiders sell, although it looks like they have done the wrong thing here in this graph. I actually want to talk to. Do I skip this because I didn't talk about it? You kind of criticized me.
I don't, and go ahead, take your best shot.
He has a paper where he basically says that total shareholder return does not measure actual returns to all shareholders. When a company buys back undervalued stock, it's a wealth transfer from sellers to long-term investors. I fully agree with you. But what does it mean to maximize shareholder value? For me, maximizing shareholder value means maximizing the wealth of the current long-term stockholders. Investors who sell to the firm after a buyback would have sold anyway, because an open market buyback is regulated in the sense that you cannot influence the trading volume. The people that sell would have sold anyway. So not repurchasing undervalued shares will transfer wealth from long-term investors to other people that are not part of the current investor pool, which I think is bad corporate governance. And I think so. The whole idea is, why do people actually do not like buybacks? I think the main reason people don't like buybacks is because it's good for shareholder value. It's the ultimate pro-shareholder value thing. It's not a stakeholder value thing. Stakeholder value maximization means no buybacks. And to prove that, I have a new paper in process. That the likelihood of a buyback is negatively correlated with ESG, which shows that ESG is an anti-shareholder value ideology. It's not a win-win story like they keep telling you in the newspaper, right? It's an anti-shareholder value thing. This is the most ultimate proof here. And I'm starting my anti-ESG mission today. All right, with this, you too, right? We're going to get together on this. I think that maximizing stakeholder value is not the job of a CFO. The CFO is not picked by society. The CFO is picked by the shareholders. And that you're supposed to maximize the wealth of people who pay your salary, not society. Who cares about society? Politicians. They have to care about society, but who picks politicians? Stakeholders. They do what stakeholders do. But we as stockholders, we should ignore and try to counteract whatever politicians want us to do. So market may have a short-term view. The market, in other words, they overreact to short-term bad earnings. But they attach too much weight to those. But the managers have a long-term view. They take advantage of this undervalued stock to the benefit of their long-term shares. So buybacks are a symbol of long-termism, the opposite of short-termism. And I thank you very much for listening to me, because nobody usually does.
I can sit there maybe. Yeah, perhaps to take some questions. Jesse, you want to react first?
Sure. Couple of things. One is we James get the slides.
Well, your side. Oh,
I'll give it to you.
So in this paper where you're looking at the stock price relative to repurchase, are you looking only at companies that actually ended up repurchasing stock?
No, this is all the companies that announce, this is a buyback authorizations by the board of directors.
Because like there's a paper that was published sometime in the last 10 years that showed that like 25% of buyback announcements are not followed by a single repurchase of a share in the next 4 years.
Sure, because this is announced, the announcement is obvious that this is an option to repurchase shares. There's an immediate disclaimer at the bottom saying this is not a requirement of buyback. We want to create an option. And actually, it's a puzzle why not everybody creates this option, because you don't have to exercise an option if it's not in the money. What does it mean in the money? Well, it turns out to be that your investment in your stock is the best thing around. It may well be that later on your stock price gets corrected, the market becomes efficient, it's no longer undervalued, so you don't do it, right? It would be not socially responsible to go and buy the shares when they're no longer undervalued and when the market has corrected. So these are the companies that have a paper also with Laconishak on Canadian buybacks, where in Canada you could actually see when companies actually, they have to report monthly which shares they repurchase. And you can see that those companies that have announced a buyback and do not repurchase them are the ones that go up a lot in the short run, so they don't do them. The ones that actually do them is that they not go up in the short run and they go up longer. In other words, they think their stock is still undervalued and they buy them. But I think there's nothing wrong with saying that you should not force companies to buy back stock when their shares are no longer undervalued, or when they're even overvalued, or when they when there's a better opportunity to invest in new kind of
Can I just follow up with another question?
Yeah.
Since I don't see any hands that I'm. Okay. Just so Rob Jackson's claim about there being a problem with insiders selling right after a repurchase announcement. I basically agree with you that it's not sort of necessarily indicative of a problem. In fact, I would go a little further than you and say that we want managers to be compensated for the increased value that they generate.
Right.
And when a company announces a buyback, it basically means that excess capital is being released, which is good for shareholders that could be responsible for the price going up. So we would want managers to like get the benefit of that increase in stock price relative to selling before they make the announcement. So I would go further than you in sort of praising post-announcement sales along that dimension, but there could be situations where buyback announcements are made. The managers know that they're actually not going to buy back any shares at the time of the announcement. And I know that this happened in 1987 when the stock market crashed. There were companies basically went to Wall Street and they said, we're going to announce a buyback. The market fell like 30%. Companies went to the market and said, we're going to buy back shares. And then they told like their banks, we're not actually going to buy back any shares, because the banks were worried that like equity capital was going to drain out of these companies. So we have anecdotal evidence from not so long ago that buyback announcements can be made not with the intention of buying back shares.
I was hardly born in 87.
What?
I mean, I was 87. That's a long time. Is the mini crash?
You were an adult then.
Okay, all right. But the fact that the market recovered pretty quickly afterwards, right?
Well, I'm not saying this thing. I'm just saying that
it was driven by September.
Yeah.
So you're talking about 2011?
1987.
Okay.
But the point is that given that 25% of buyback announcements are not followed by a repurchase, and it could be for okay reasons, like the stock price subsequently goes up, and so it doesn't make sense to buy, or it could be that there's manipulation going on. So it would be helpful if you want to like be as robust in your defense of buybacks as you are to like try to deal with that.
Yeah, but people get killed by knives, right? Does it mean that all knives are bad? No. I mean, sometimes people that do. On average, my wife and me swim 1 kilometer a day. Okay, she swims 2. So the average the average doesn't mean anything, right? I mean, of course, there are all exceptions that these things are bad, but this critique of buyback is a general state. It's like, I don't hate this type of people. I don't hate this type of event. And it's driven by, he's talking about the average buyback, and the average buyback, and there are exceptions indeed that the people manipulate. There are unethical people, not in the room here, but some people outside may not be ethical and manipulate the stock. But on average, there is no proof that these things are not driven by sound reasons. And that's why, and again, there are options, right? There are options to buy back stock. They're not obligations. They don't do anything wrong. They just say, if we feel like it, if the time is right, we're going to buy back stock. That's what they say. They do not say we're going to buy back shares tomorrow. They don't say that. They do not say that.
No,
So
I
if they
know
don't do
that-
them, then that's not a violation of the promise.
But, well, I don't want to absorb all the time, so we can
Maybe.
continue this after.
Yeah.
Maybe, well, I mean, you probably don't need more ammunition, but if you want even more ammunition, the data on the long-term data, right, on payouts for the S&P 500, and Bob Schiller has this data, is that from the 1930s to the 1960s, payouts were as high as they are today. And it's only the 70s and 80s that were low. And since then, they've been high again, except that in the 80s, of course, they became buybacks. Before that, they were all dividends. So this argument that payouts are much higher than they used to be is comparing it to 2 decades, really. And I think what happened in the 70s and the 80s, there was more volatility. And when there's more volatility, you hate to pay a dividend because you don't want to cut it. Right. And then giving companies the option to buy back, then allowed companies to pay that out again. So that's, I mean, if you need more ammunition. The other thing that might be useful to look at is looking at things like selling general administrative expenses to sales and advertising to sales, because these things measure more intangibles as investments, because R&D and OpEx, those are the tangibles, of course. But given that nature of businesses have changed, some SG&A and some, advertising is just brand capital. It's just an investment in brand capital. So I think that would, make your case even more than you already do.
Thank you. That's very helpful.
Also, the different dividend is a commitment, right? If I'm announcing a dividend, I'm going to pay it. If I don't pay it, my stock gets punished. That's why people like buyback, because it's not a commitment. Buybacks are like dating. Dividends is marriage. Okay? That's the main difference. And therefore, people prefer the flexibility. And the fact that they use the flexibility by not doing it, I think that's not surprising. That's kind of that's perfectly consistent with good governance and with honesty. So therefore, there's no reason to go out and say, well, some of them don't do it, but they don't do it for good reasons. Okay. Because you need to have money to buy back stock, right? I mean, I'm doing now a study where I send an email to every stock that goes down by at least 20% per day. And I asked the guys, maybe you should think about a buyback. And I show a copy of my paper, my graphs. Then the vast majority says, well, we don't have any money. That's the purpose. The main reason why companies do not buy back stock when they go down is because they don't have any money. They don't have any debt capacity. They don't have any cash flow. So the point is, there's a lot of firms that do not use the option because they don't have, you need financial resources to finance a repurchase. And you may be coming in a situation that you go to COVID. In COVID, a lot of buybacks were canceled. Why? Because people said, well, we cannot do business with in COVID, so therefore we stopped doing buybacks. Is that irresponsible? No, I think it's the normal business practice to manage your capital in a way is consistent with the financial distress.
Okay, we have 2 more questions. So, anybody?
Yes, thank you. I have a question for Jesse. So I fully agree with your critique of this EY study, but I was wondering if is there a like empirically sound, logical way to look at share buybacks and R&D investments together at the same time, because I do think it's an interesting combination to look at.
Well, you could look at them for what purpose? To try to figure out whether buybacks impair R&D?
Yeah, for example.
Because what we do is we sort of look at like capital outflows and the level of R&D in the market. R&D is like going through the roof. But, it is possible that on the margin at particular firms, share repurchases reduce R&D. Then the question, and Mark, Holger, or other people in the room may be aware of these types of papers. And the question always is the question I asked Zach. Well, how do we know that's bad? There's a lot of, overinvestment. There's a lot of reasons to believe there's going to be overinvestment by managers in various things that, to build empires, or because it's like their pet idea. And so when you see a reduction in something, like what is the normative implication? We don't know. I think it's hard. Above my pay grade.
Marco?
I was going to ask you about tax, but I'm not going to.
Tax on what?
Okay.
Well, dividends, debt,
Yeah, but that's,
buybacks.
well, I was talking about tax advantage, corporate tax advantages from borrowing money and deducting interest payments. Also, you can actually call it from, even if you use excess cash, pay tax on the interest that you have on your excess cash. You can save that in tax if you use the share to buy back stock. I'm talking about corporate advantages, right? I'm not getting into debate here between personal taxes on dividends and capital gains. I mean, it's like, this is just like a capital gain, right? When you sell shares to the company, it's like shares in the market. I mean, there's nothing particular about buybacks taxation that's different from capital gains tax in general. So that's not really a topic, I think. You worry about tax because you're.
Mark, you wanted to have the last word, or?
It's not really a last word because it's not as important as what you've always said, but just something to put on the table. I think the following is in some of your work and some of the stuff that I did. If you look at the payouts from the S&P 500 and compare it to the results of the non-S&P 500, I think you'll tend to see that there are net payouts from the S&P 500, basically exporters of capital, and the non-S&P 500 are importers of capital. That's kind of what you'd expect from, or what you'd want from a well-functioning financial market. That at least overall, you'd expect that the cash cows that generate enough money from current operations tend to be the larger companies, and will throw off more cash that they can't use well in their business, and that smaller companies, the non-S&P 500, are companies that need to import cash because they have opportunities, but not enough cash to make them happen.
Yeah, so Tom said I had 20 minutes. It seemed like at the end I had an extra couple of minutes, and if I'd known that, I would have put in the slides for the non-S&P 500 companies, because they are net importers of equity capital. Which is why you have public markets. I mean, why do we have public markets? We have public markets so that companies can raise equity capital. And when the company has gotten mature enough and it's run out of good things to do and it's very profitable, what is the natural thing in life of the economy to happen? The capital moves from the big companies that can't deploy it to the smaller companies that are growing fast and hiring people and investing. And we see in like the non-S&P 500 public companies that if you look at their net equity issuances, they're positive, or net capital flows from shareholders to firms are positive. And if like 15% of the net capital outflows from the S&P 500, equals like what's going into the smaller publicly traded companies. And then a lot of it goes into venture-backed and PE-backed companies.
I think we have to wrap up here, but thank you for a very excellent discussion.